Sam Stovall is with us, Chief Investment Strategist at CFR Research. So Sam, good is good. I guess now that we're post-Fed and we're truly data dependent, the market likes this number. You think it's going to last?
I think it will, Oliver. I mean, basically, the old adage is that prices lead fundamentals. Fundamentally, people were expecting that we would end up with a 1.5% GDP growth rate in the most recent quarter. Earnings we've been seeing come in better than expected for the third quarter, but being whittled down in the fourth quarter of this year and 2020 estimates. Yet the market continues to work higher. I think that implication is that investors are now saying, what's the risk that the estimates are wrong? Do I have the risk to the upside or the downside? And I think that they're saying that the risk is to the upside, that we end up with stronger economic growth and, as a result, upwardly revised earnings.
Yeah. So, Sam, this is an interesting response. The bond market is kind of saying, all right, we get it. Things are pretty good here, but we're not going to undo our move from yesterday. Stocks didn't really get a lot of day two from Jay Powell. It seemed like we were wavering, looking for direction. We didn't get the usual accommodative policy type move. Bonds seemed to view it as accommodative, but equity markets were a little bit flat in the post-session. So how do we interpret this number combined with what we heard from Jay Powell?
Well, I think we had 3 weeks of upward movement in anticipation of the Fed meeting and Powell doing what he did. So I really think that the last trading day of October was the result of the news regarding China being used as an excuse to take some profits, but not experiencing a change in the overall trend. Yes, I think we'll have to be on hold for a little while. We've got to wait until the December FOMC meeting to find out what happens next. We have to wait to hear when the U.S. and China will meet once again to sign phase one. And yes, we have to wait probably until January of 2020 to get a read on Q4 earnings, because we're on the leeward side of the Q3 earnings reporting season. And I don't think that remaining earnings reports will have much of an effect on the market.
All right. So, Sam, in the past, we've seen complications when there's good data for stocks. Obviously, the old, good is bad situation. But given how deep the recessionary fears were, I think it makes sense to see stocks responding to this. However, for those that are still seeing this as that kind of late cycle period, I know that phrase has been used and used over and over again. But what do you see from this typical kind of response and what to expect around this time, if indeed we are getting a little bit of late cycle strength?
Well, I think that we're going into the classic 6-month rotation. The old adage of sell in May and go away. Well, I say rotate, don't retreat. Go defensively May through October. Well, here we are now, November 1st. Historically, you want leaning from November 1st until April 30th, gravitating toward consumer discretionary, industrials, materials, and tech stocks. And my most recent seasonal rotation strategy, which Pacer put together as an ETF with the ticker SZNE, beat the market by about a 2-to-1 margin in the most recent May through October period, and is currently positioned in those 4 cyclically leaning sectors.
So walk me through which ones those are right now. How do you define those cyclically leaning sectors in today's environment, Sam?
Well, if you wanted to invest in them individually through ETFs, you could look at XLY, consumer discretionary, XLI, industrials, XLB, materials, and XLK, technology, or the ticker SZNE if you wanted it to be done for you.
So, Sam, is your rotation strategy here then one that is basically betting on a continuation of what we've seen since September, which is financial leadership and some industrial and material strength?
Yes, that seasonally, this is typically what happens. It's almost like whitewater rafting. You let the market take you where it wants to go. And from November through April, it typically wants to go cyclical. Reason being that we have optimism that kicks in the seasonal period of November and December. Then we have heavy capital inflows that typically take place from January through April. And so I think that even though we are on the latter phases of this bull market and economic expansion, I don't see it ending in the next 6 months.
So the 6-month price changes after November through April, that's the time period that you're looking at here where those discretionary industrials materials lead. So my guess is, Sam, that you want to see the good numbers like we got this morning. You probably want to see some fall through on ISM. Is the risk, though, in this seasonal pattern breaking down if some of the recessionary bears are right and we do see more softness that's crept up from this summer?
Certainly, if we end up seeing a turnaround and the numbers really start to go south, employment data, consumer confidence data, consumer spending, et cetera, then those trends would have to be broken. The manufacturing side, yes, has been weak for a while, but I remind investors that the U.S. manufacturing is about 10%, whereas services is 90%. So my feeling is that we're getting a clue from the market that it believes that future numbers are going to be upwardly revised, not downwardly revised. We're still not looking at an earnings recession. The last time we had a single quarter of down earnings was Q3 of 1998, which left us with another year and a half of a bull market.
Yeah. All right. Rotate, don't retreat. I like it. It's a little different than sell in May, Sam. That sounds good to me. SZNE is the ETF. Mr. Stovall, always a good take. Appreciate it, Sam.
Thanks, Oliver.